Right. Well, my core message in times like this when we have such volatility in the market is to stay diversified, right? Because it's very difficult to predict which sectors or which factors are going to work at any specific point in time. So we maintain a well-diversified portfolio. We're actually underweight energy, underweight materials. We're overweight consumer discretionary as well as consumer staples.
Okay.
And that has really helped us in terms of our performance relative to the broader market. We don't have much exposure to utilities, but we do have a good foothold in REITs, which has also been helpful.
Yeah, Kevin, you say your investment strategy now, you change a little to pick companies with cash on the books and very little debt. Can you explain that?
Sure. So when you look at the big picture here, what you have going on is an extraordinary amount of excess savings in China that has been built up for decades, which is now being worked out of the system and perhaps moved into the rest of the economy. Ultimately, what that means is that a disruptive process of some kind could take hold, and consequently, you have a tendency for more deflationary kind of pressures than inflationary pressures. So with more uncertainty and with greater chances of deflationary pressures, we want to own companies that are very consistent with debt that's very low on the balance sheet and more cash on the balance sheet, because that would tend to do better in that kind of environment.
Any examples of that, sectors or
Sure.
companies?
So that would focus us on healthcare. That would focus on consumer, both discretionary and staples, where the balance sheets are typically very good. Technology would be another one, and mostly here in the United States, where the data seems to be consistent with an economy that's expanding, and we see most of the pressure reflected in these inverted yield curves coming from outside our borders.
So, Valerie, let me ask you a kind of fuzzy question.
Okay.
There are certain things on the investment horizon that you can see coming.
Right.
There's some things that maybe you can see coming, like an inverted yield curve. You could kind of think that might have been around the corner. There are other things that you can't see coming, like the president introducing tariffs. Well, maybe you could have, but then postponing them and then putting them back on, whatever.
Right.
So how do you invest against things that you can see coming, the things that maybe you could see coming, and then the things that can smack you out of nowhere? What do you do?
As I said before, I think it's really, really important to maintain diversification for the reasons that you just articulated. One of the things that we do in the portfolio that I manage is to look at corporate responsibility and sustainability as an additional factor that we embed into our investment process. And here's why. There's a lot of evidence that shows that companies that consistently underperform on environmental, social, and governance issues actually have more risk, right? So if you're in an environment like we have now, where you have a lot of volatility, that's an underappreciated way of mitigating some of the volatility in the broader market.